Hey, Garage Gang, it's Tuesday, February 17th, Fat Tuesday. What did you give up? Sugar, carbs, caffeine, hopefully not your liquidity. Because if you gave up your liquidity in this market, the block is hot and the dealers are not playing nice. It's me, your boy, Avatar John. And tonight we are not talking about 5-minute candles. We are talking about a collision. Macro, crypto, AI, sovereign capital, policy shifts, geopolitical tension, the forest is moving. The CFTC chair says they are going to future-proof crypto regulations. Vice President Vance says Iran talks went well. UAE sovereign wealth fund Mubadala increases its spot Bitcoin ETF exposure by 45%. There's a 74% chance the Supreme Court rules Trump's tariffs illegal. Yes, we are breaking all of it down so you understand exactly what this really means. But first, if you value big picture analysis instead of emotional reactions, smash like, hit follow, subscribe to the channel, and share this with someone who wants to actually understand how finance works. We don't chase hype in the garage, we build frameworks, and here's the kicker. YouTube is down worldwide. When infrastructure flickers, volatility reminds you who's really in control. The block is hot. Let's pop the clutch. If you want to understand crypto, you have to understand Tradfi. And wait, just in case you don't understand the term Tradfi, that means traditional finance, Wall Street, the suits, the bond desks, the hedge funds, the pension allocators, the capital that actually moves the machine. Tradfi moves first, crypto reacts second. Warren Buffett just reduced Berkshire's Amazon stake by 77%. He trimmed Apple, he added Chevron, started a New York Times position. That's not random, that is defensive rotation. When Buffett trims mega cap tech and adds energy exposure, he is adjusting for macro durability and earnings resilience. That tells you capital is thinking about cash flow stability, not hype. Meanwhile, stocks eked out gains in a topsy-turvy session. The VIX actually fell, complacency creeping in, but the MOVE index, bond volatility, remains elevated. And when bonds are unstable, equity calm is temporary. Here's why that matters. Tomorrow we get FOMC minutes. Tomorrow we get a 20-year Treasury auction. Barr already framed the tone, rates steady for some time. More evidence needed before easing. That is not dovish, that is plateau discipline. Here's the transmission chain. If the 20-year auction is weak, long duration yields rise, cost of capital increases, risk parity funds reduce exposure, CTAs adjust duration models, dollar firms, equities wobble, crypto de-risks. If the auction is strong, yields stabilize, risk breathes. Bitcoin tests the 70 to 72,000 magnet zone. Shorts feel pressure. This is liquidity mechanics, not vibes. Now layer in geopolitics. Vance says Iran talks went well. That compresses risk premium, temporarily. But the USS Gerald R. Ford is deployed to the Middle East. That keeps geopolitical volatility embedded. Oil shifts, inflation expectations move, yields respond. Tradfi absorbs that first. Crypto amplifies it. That's the forest, not the tree. Now we're done playing around. Let's talk about what actually moves markets. Not vibes, not comments, not influencers screaming bottom. Leverage. Because price does not move on hope. Price moves on positioning. Bitcoin already flushed. The obvious overleveraged tourists got cleaned out. Funding cooled. Open interest reset. That's healthy. But here's the problem. Healthy doesn't mean explosive. Bitcoin is sitting below the magnet zone, 70 to 72,000. That's where trapped shorts feel pressure. Below that, it's neutral ground. It's chess, not fireworks. Now Ethereum is fine, not crowded, not euphoric, not terrified. It will move with liquidity. Nothing dramatic there. But Solana, that's where it gets interesting. Open interest sticky. Funding still positive, price soft. That's not strength. That's leverage refusing to admit it's wrong. And in this environment, sticky leverage is dangerous leverage. Because when macro hits, it doesn't tap you on the shoulder. It kicks the door in. If tomorrow's bond auction is weak and rates spike, Solana is the first domino. Not because it's a bad project, because leverage unwinds mechanically. No emotion, no mercy. Weak auction leading to yields rise, leading to dollar, strengthens, leading to equities wobble. Crypto de-risks. High beta chains bleed first. That's the chain reaction. And if you don't understand that chain reaction, you're not trading, you're gambling. Now let's zoom out. Tradfi, Yes, Tradfi, that means traditional finance. Wall Street, the suits, the bond desks, the people who move trillions before breakfast. Warren Buffett just cut Amazon by 77%, trimmed Apple, added Chevron, started a New York Times position. That's not random, that's defensive positioning. That's someone saying, I see macro risk. Meanwhile, stocks are acting calm. VIX drifting lower, but bond volatility is elevated. And when bonds are nervous, equities are pretending. The real stress shows up in rates first, and rates are not relaxed. Now layer in geopolitics. Iran talks went well, great, until they don't. An aircraft carrier doesn't get deployed for vibes. Risk premium is compressed temporarily, but the environment is still fragile. Now tariffs, 74% chance they get struck down. Everyone screams bullish, maybe short term. But understand this, we already paid the price. Supply chains already shifted, capital already moved. Striking tariffs now doesn't rewind the clock. It introduces unpredictability. Markets don't fear high costs, they fear unstable rules. Short-term pop? Maybe. Structural reset? No. Because the real game isn't tariffs, it's AI. $600+ billion in global AI capex. That's not hype, that's nations building compute dominance. Energy plus AI equals power, and machines need rails. Crypto is quietly positioning as machine settlement infrastructure. That's the long game, that's the forest. But here's the part most people miss. Long-term bullish does not mean short-term safe. Regulation stabilizing? Bullish. Sovereign wealth stacking Bitcoin? Bullish. AI infrastructure exploding? Bullish. But if rates spike tomorrow, none of that saves over-leveraged traders. Macro crushes narratives in the short term, always. So here's the posture. If the auction is weak and minutes lean hawkish, you respect it, you don't fight it. If the auction is strong and minutes are neutral, you trade relief, but you don't marry it. We are not chasing dopamine in this garage, we are reading structure. And structure right now says, macro still in control. Leverage partially cleared, Solana exposed, Bitcoin neutral but coiled, regulatory clarity improving, sovereign capital positioning, AI infrastructure accelerating. That's the map. Not feelings, not Twitter polls. This is transition. And in transitions, amateurs panic. Professionals position. The block is hot. Smash like, subscribe. Share this with someone who wants to think bigger than the crowd. And check out the website, gurucryptogarage.guru. We're building frameworks, not feelings. Engines ready. Let it rip.